It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Hey, we welcome you back to the podcast, Episode 10. Episode 10, Managing Your Financial Future. What is this, Professor Plum? Season 3, I think? Or are we? No, I don't mean 3. Season 7?
I was going to say 3?
No, it's not 3. No, I'm looking at the number 3 here. Season 7.
Season 7, Episode 10.
Episode 10, all right.
Take 1.
That's right. We're approaching the end of the year here. And I don't know yet which episodes, if we're going to have, we usually do 12 a year, 12 a season. And then we have a couple weeks off. Yeah, just, give everybody a break and time to catch up. And then we start up again. But that break is going to happen like the first couple weeks of December.
So we make it take a little bit longer break.
I don't know yet. We're trying to figure that out. What's the best way to do it?
Because around Christmas time, people don't want to talk about finances.
Are they? Yeah,
they don't want
to
talk about saving. They don't want to talk about controlling their credit card. They don't even want to talk about money. They just want to.
Well, they want to spend, and that's what they're supposed to do.
Maybe they can spend this year. Maybe they won't be able to find what they're looking for. Who knows about the supply chain issues?
I heard it's already an issue with certain a lot of products that may not be here in time for Christmas. It's really interesting. As I was trying to buy an online gift for my wife, and they only had like XXL and double small or whatever it was. I mean, they had nothing available.
Double small.
I don't know what it is, but it was like newborn size or something. And
for adults.
Exactly. It's what it was. And obviously nobody's going to buy either one of those, especially
That's probably why they're
side.
Still available.
They are still available. And that was all I could buy. And I thought, oh, man, are we in trouble for Christmas?
Well, if you were any good with a sewing machine or anything, you could buy a XXX and make 3 or 4 or 5 of the regular size ones.
I could just get a pair of pinking shears, cut them up, and make new shirts out of them. Anyway, yeah, that could be an issue. I don't know. So the supply of podcasts on our
might be a little light as well at the end of the year.
So we got to figure that out. Last year I think we ended the season right at the end of the year, and so it worked out perfectly. But this year we're going to have to do that. But anyway, you folks who listen to this podcast, you're probably listening to this at least a month, maybe longer away. So you may already know what we're going to be doing. We appreciate that too, by the way. Go to Spotify. You can subscribe to us on Spotify. I should tell you that here right up the front. I'm Johnny Dean, your podcast host here, not an advisor, sitting with the person who is an advisor, Professor Rick Plum, certified financial planner professional. And we're going to be talking here today. Now, like I said, I don't know when people are listening to this, but this is important to know whether it's the end of the year or the beginning of the year or any particular time. Now, I know we bring up taxes on a semi-regular basis, and there is a good reason for that. As we've said, and just about every tax podcast we've done, Professor Plum, they are, I believe, the biggest drag on your portfolio's return, or can be.
And it's definitely a drag on your psyche.
Well, it really is, because they just don't. You can miss things, and if you don't know how something is going to be taxed, you could wind up being overtaxed.
And there are a lot of urban myths, legends, whatever you want to call it. A lot of what people consider to be truths that I have no idea where they came from, and they're just wrong.
Well, I think you brought that up because I think you may have spoken to somebody today.
I speak to people, this morning
about that.
Yeah, it had to do with the Roth conversions, and
because we talked about that.
The limits on how much they can convert or not convert. And I talked to somebody else about the taxability of Social Security, and they were under some misconceptions there. They thought that it was fully taxable right off the bat, and as soon as their total income got over a certain threshold, including all of their Social Security, boom, it just 85%. Like it was a trigger. There was no in between.
And all of a sudden, you don't owe this much. Now you owe tax on 85%.
That last dollar you took out of the IRA
ruined the whole thing.
Oh man, that cost you thousands.
Right, exactly. So what we try to do is clear up as many misconceptions as we can. I hope you told these people to listen to our podcasts and find.
I just hung up on them. No, I'm kidding.
But you can find the topics and learn a little bit about this. And this is kind of what I want to get to today. We've talked in previous podcasts about the brackets and how the bracket works. You just kind of alluded to that here, Professor. their income, let's say, is taxed in tiers. Brackets, we call them, but they're different tiers, right?
Right. I mean, the first tier, basically, though, that doesn't show up on the sheet is a zero. You don't pay tax on the first X amount of dollars that is on your tax return. So, I mean, the first thing is to figure out how much actually goes on the tax return. You know, if you have a 401, if you make $100,000 a year and you have a 401k, you're putting $10,000 a year into the 401k. $100,000 doesn't go on the tax return, and then you reduce it by the 10. So now you're short. Only the 90 goes there. The money that you spend on your medical, group medical through your employer, if you're paying it that way, doesn't show up on the tax return at all. So you got to figure out first off what goes on the tax return. And then even once you've added up all the stuff that goes on the tax return, the first X dollars, married couple has about almost $26,000 that is not taxable at all. And then when you get to 65, a bigger chunk is not taxable. So if you have two people, even more money is not taxable. So we don't even start the tax brackets until we get a little ways into the income that we have on our tax return.
Now, when you say the first X number of dollars is not taxable, that has to do with the
standard deduction. Currently, it's just the standard deduction. In the past, it was a standard deduction and personal exemptions. There was two different pieces to it. And we may go back to that in 2026 or later.
Please do it like next year. I want it back. I want the personal exemptions back, like they're listening to me. So that's how this works. It's a tiered system, as I said, and brackets, and some income is taxed at 0, some is taxed at 10.
Right. Then the first married couple, you figure out what your gross income on the tax return is. The first $25,100 is not taxed at all. You take that $25,100 block, you set it off the side, and you don't talk about it again. And then the next almost $19,000, or a little over $19,000, is taxed in a 10% bracket. If that's the only income you have, that's the only tax you pay. And then if you're over that, if you got 25 plus 19, so you're at 44,000, you take that. Now you figured out the tax on that, set it aside. Now you're into the next bracket, which is the 12% bracket. So you just work your way up the brackets. It's not a matter of any retroactivity. You don't go back and look at the income that was already there for the actual physical, federal, or even that, for that matter, state income tax.
Yeah, so you could probably figure out your taxes before any other, deductions and all that stuff. You could probably figure out what your taxes owed are if you know ahead of time what you're going to be putting into your 401k, your retirement
What
plan
your medical expenses.
If you
your
have
pre-tax, your pre-tax things that come out of your paycheck.
Yes, that's it. Yeah, your medical
dental,
said medical expenses.
Not expenses. Medical dental premiums.
Health insurance.
Yeah, your health insurance. Exactly. Excuse me for misspeaking.
That's all right. I've thought not everybody has a medical expense that they can.
It's hard to get your the physical medical expenses you pay out of pocket deductible because you have to.
It's almost like you got to fall off a bike and wind up getting being
in a hospital for 10 days or something.
Boy, then it can really help. So anyway, what we're talking about here is how things are taxed. And I think I've said, and you said before, knowledge is power, and this is what we're talking about with tax rates. I want to take an example, and if you folks have seen the Lucia Capital Group Weekly, I hope you subscribe to that too. You get a video on this stuff, a little 3-4 minute every Thursday, 3-4 minute video goes out with Professor Plum. But we talked about this, and I want to expand on this. We're going to take stocks as an example. If you want to own stocks, as near as I can tell, you can own them personally, brokerage account.
Right.
You can own them in your Roth IRA. You can own them in a traditional IRA.
Right.
Or your 401k, we'll call it
right.
your retirement plan at work.
Right.
What am I missing? Is there anything else?
Those cover the majority of them.
All right. Now, here's the thing. When you take money, so you put them in one or all or some combination of those accounts. When you take the money out of one or combination of those accounts, how are they taxed? Well, the answer, Professor Plum, I assume, has to do with which account you took it out of.
Well, most definitely it has to do. If I own a stock, let's say I paid $5,000 for it.
Okay, yeah, just
years ago, and I'm looking at it today, and it's worth $25,000.
Wow, that's a nice gain.
Well, I didn't say how many years ago I bought it. I mean,
could be 50 years ago.
50 years ago.
Right, exactly.
Or it could be a couple years ago, the way things have gone, and
who knows,
depending on which stock you did or did not buy.
Right.
But if I own it personally, and I sell that stock, I paid $5. It's worth $25. There was no dividend reinvestment, so I don't have to worry about any of that. There's a $20,000 gain. Now, if I own that stock personally, that $20,000 gain is going to be taxable to me as a capital gain because I've held it for many years. It's a long-term capital gain. It goes onto my tax return as a long-term capital gain. $20,000. It doesn't matter what I do with the money. It's a $20,000 capital gain.
If
I sell it personally,
you sell the whole thing out and you sell it. Now let's just be
but
clear.
now I sell it and I have $25,000.
Yes,
I sold because I paid $5 for it. It's now worth $25. My gain is $20. But if I sell it, I got $25,000. I can go do something with. I can blow it. I can go on vacation. I can do.
Well, yeah, you've paid the taxes out of another account.
The $25,000 less whatever I owe in taxes.
Right now, let's just be clear. What you mean when you say I own it personally?
I own it in a brokerage account. I do not own it in any kind of tax sheltered account. It's not an IRA, a Roth IRA, a 401k, 457, any one of the numbers of different types of tax deferred retirement accounts that you can use. I owned it. I took money out of my bank account, plopped it into the brokerage account, said, online point click. Of course, if it was that long ago, I wouldn't have been able to do this.
You wrote a check. You went down to the building and wrote a check.
Yeah. Check. Wow. People still do that?
My wife does. I can't believe it, but she does.
But that's where I own it personally. It's in my name. It's not in an IRA, 401k, any kind of tax deferred account. And so as soon as I trigger that sale, the taxable event, whatever the taxable event is now what they call realized. Before I sell it, I can look at my statement and it looks like a really nice picture of $25,000 in XYZ stock. But that's if the stock goes down before I sell it, that gain goes away. So when you're looking at what they call paper gains, that's called unrealized. It's not realized until I pull the trigger and sell it. Once I sell it, that's a realized gain. You could also call that a taxable gain.
Well, that's what it is. And it's taxable, as you said. We're only speaking right now about
personal accounts.
This particular stock example in a personal account. You sell it, it's a capital gain, and so you are paying what they call capital gains tax rates.
Right. So let's say that the reason I'm selling the stock is I need a new roof, or I need something at the house. I need to remodel this or do that. It's going to cost about $25,000.
Okay.
I need to get my hands on some cash.
Yeah.
And so I decide I'm going to sell this stock. I'm going to sell this. I'm going to get $25,000, and I'm going to pay tax, capital gain rates, which long-term capital gain rates are taxed at a lower bracket generally than ordinary income.
Under current law.
Ordinary income is interest, things like that. Capital gains are from capital assets, things that I own and I sell from a gain or a loss. So it's in my personal account. I'm going to pay taxes on that $20,000 worth of gain. Now I can go do whatever I want with the money.
Whatever's left over.
Now, if that money had been in an IRA, a traditional IRA.
Yes.
Most likely, I know, I'm assuming I did not make any after-tax contributions to the IRA. Everything I put in the IRA was on a pre-tax basis. I either got a deduction for it or it came from my 401k. I rolled it over. The entire IRA is pre-tax.
So we're talking about the same $5,000 stock you bought.
So I also bought the same $5,000 worth of stock inside my IRA.
Traditional IRA.
Traditional IRA.
And what happened when you bought it?
Well, the money that was in the IRA, I took a deduction for it when I put the money in.
So that $5,000 that you put in,
I saved some money in taxes on that money when I put it in.
So you actually deducted $5,000, which means that now that money is considered pre-tax.
Right. So I sell the stock. There's $25,000 sitting in my IRA now. I don't owe any taxes on that sale because the money's still in the IRA. But I needed the reason I sold the stock is because I needed some money. I needed some cash. And because I'm older now, I'm over 59 and a half, I can take money out of my IRA without any kind of penalty. All I have to do is worry about the taxes. So I pull that $25,000 out of the IRA. It is all taxable. All $25,000 is taxable.
And it's taxable at what rate, Professor Plum? Because this was a stock you sold, and
it is a capital asset.
According to what you said about 4 minutes ago, it's a capital asset that wouldn't that be taxed at capital gains rates?
Well, not to be too technical, but I didn't sell it. My IRA, or the IRA that I'm a beneficiary of, sold it. The IRA is a tax-deferred account. And now the money is in the IRA, and the IRA is distributing cash to me or distributing something to me. When an IRA distributes something to you, there is no differentiation between capital asset, interest-bearing, this, that, or the other, principal, earnings. It is an IRA distribution, and an IRA distribution from a 100% pre-tax IRA is 100% taxable as ordinary income. The fact that I don't have to pay taxes on the buys and the sells and the reinvestment and everything inside the IRA, that's great. I get to use that tax deferral for as long as I can until they require me to take money out. But once I start taking money out, that's ordinary income. There is no capital gain associated with an IRA in today's world.
Yeah, when you say ordinary income, you're talking about you have to go to your tax return and it's added to your income for that year,
Right.
as if you know, like your wages. And
It just gets stacked on top of the brackets that you've already calculated for the rest of your income. It just becomes more income, either in the same or maybe even it can push you into a higher bracket at that point.
So there's a good chance. I mean, there's a chance that you're going to wind up paying more taxes because it was in your taxes on that $25,000.
Oh, definitely. I cannot think of a situation where if I sold a stock for $25,000 that I own personally, $5,000 basis, or I sold a stock in my IRA for $25,000 with a $5,000 basis and took the money out of the IRA, the IRA will always create a higher tax than selling it with a capital gain.
Yeah.
Because it's going to be the same. One has $25,000 of ordinary income on my tax return. The other one has $20,000 of capital gain on my tax return.
What if that was your only income for the year?
Well, then I'm not going to owe any taxes on it either way because I'm a married person.
Right. So
and I get $25,000 of standard deduction.
Okay, so it could be equal to.
Yeah, it can't
won't
be
always
lower.
be more, but it won't be lower than the capital gain. You like to get technical. I'm just throwing this out. You want to make sure you're covered every which way.
Okay,
But anyway, the point is that when you take it out of your traditional IRA,
it'll be more taxable. The gains in your IRA.
Figure on paying more taxes.
Yeah, it's just a little bit. But the good news may be that if I deducted the money in a higher tax bracket than the bracket I'm taking it out, and I didn't pay any taxes along the way when I was selling and reinvesting and everything, then I may still make some money from the tax advantage of deducting it higher, paying it in lower later on in life. Because maybe I don't have any other income, and that's the only income I have for the year. I deducted it going in,
Yes.
and now I get to take it out tax-free in your example, darn you. Anyway.
You just wish you'd thought of it.
Now, the third type of account is the Roth account.
So this is still an IRA. So now you couldn't have bought
But it's a different kind of IRA.
Okay, yes. So let's go back and you bought something in, let's just say 1999 or something.
I bought the same stock.
It was a tech stock, maybe.
No, because those went out of business. Well,
that's true.
In
But maybe
1999, 2000.
Okay, all right. But it was
Maybe it was a good oak type of mutual fund.
Hey, like a red-colored
Yeah.
or white-colored oak or something?
No, never mind.
Never.
That's going back to the .com bust.
Yes.
But so whether I bought $5,000 personally, I bought $5,000 in my traditional IRA, I bought $5,000 in my Roth IRA. I just happen to have $5,000 in each of those three accounts. We're talking about the taxability of that same stock growing over the same number of years, more than 5, and selling it and taking the money out of the account. My Roth IRA has gone from $5,000. I did not get a deduction for putting the money in the Roth IRA.
No.
And now it's $25,000. But as I mentioned a little bit ago, I'm over 59 and a half. And I just mentioned that it's more than 5 years old. So when I sell that stock in my Roth IRA and then turn around and have them distribute the $25,000 to me to go do whatever I need to do, nothing is taxable. Nada, zilch, zero. No taxable event is happening.
One of the benefits.
That's
I
a
guess.
major benefit of a Roth IRA. The problem is, how do you get money into a Roth IRA? You have to pay taxes on the money to put it in.
Well, you do. And now we said $5,000. You couldn't have put $5,000 in one shot back in 1999.
No, I could have done it over a couple of years.
2000, over a couple of years. But let's just.
Actually, I
not
could have.
nitpick.
I did a conversion.
You did a conversion.
in
No, I'm not-
1998, and I spread the tax over 4 years. So don't go there with me.
I'm not going to because we did Roth conversions last time and we got into this. So anyway, just for those of you purists, yes, we understand that.
So how much you owe in taxes depends on where the distribution is coming from, and a couple other things like, are you 59 and a half or older? That has to do with penalties, and it potentially has to do with taxability if it's a Roth IRA. How much has it been in there for 5 years? That has a lot to do with the Roth IRA. If I was, really good at investing, or I should more likely say, if I was really lucky at investing, and last year I put in $5,000 into my Roth IRA. It's my first ever Roth IRA. Never had one before. And I just happened to pick one of those stocks that has just gone through the ceiling, and it turned into $25,000 in the last year.
Yeah.
And I sell it and take the money out. Roth IRA, it's not 5 years old. That will be a taxable event. That $20,000 of gain, because I do not have a Roth IRA in my existence
in this
for
example.
5 years. And I had a gain, and I took it out before the 5-year time horizon. All that gain, if I take it out, the principal that I put in originally, the non-taxable, the money that I did not get to take a deduction for, comes out, my basis comes out tax-free. So that $5,000 comes out tax-free. But the other 20 in gain, that is all taxable.
Now,
and it's all ordinary income because it's coming out of a form of an IRA.
You said if I bought this a couple years ago and it shot up, and so I don't have 5 years on this
I don't have
Roth.
a 5-year time horizon.
But what if I did have a Roth that had been sitting around since 2000 or something? You know,
is it still in? I've had a continuous Roth IRA.
Yeah,
I put $200 in it in 1998, and it's still $205 because I've left it in a bank account that whole time.
Right.
Now my 5-year clock has been met. They don't ask you, has this account? They ask you, have you had a Roth IRA? Any Roth IRA?
Have you been in the Roth
continuously for more than 5 tax years?
Have you been in the Roth Club?
Yes.
Shall we say?
Yeah.
Which is what that is. If you own a Roth yourself, then you're in the Roth Club. Now, if you quit somewhere along the line, you don't have money in a Roth, then the clock reverts back, right?
My son started a Roth IRA when he was 17. When he was 26, 27, I can't remember how old, maybe 28, he took everything out of his Roth IRA and used it to help him pay for his first home.
Yeah.
So he was in the club from the time he was 17 until, let's say, 27.
Yep.
But then he completely exhausted the Roth IRA, and he doesn't have any money in it again. He hasn't started contributing to a Roth again. He's doing Roth 401ks at work and things like that, but not Roth IRAs. He's no longer in the club. So if he wanted to join the club again and then start getting tax-free somehow, he'd have to set the 5-year clock running again.
So he should probably go open up a Roth for $100,
a couple $100, yeah,
whatever it is, 500, I don't care, and just be in the club again.
I did when I was 55.
All those years ago?
Yeah, because I wanted the clock running.
Yeah, that was probably a smart idea.
And in case I ever contributed more to it, or in case I contributed Roth 401k money and moved it over to a Roth IRA, because I may be in a Roth 401k for years. My entire 20 years I'm working in a Roth 401k, contributing to it, build up this huge Roth 401k. Most of it's from earnings because the earnings have just been incredible.
Hypothetically.
And then I retire, and I move that money from the Roth 401k to a Roth IRA. And I take out more than my basis, more than my cumulative contributions. That excess is going to be taxable to me.
Because
I have not had a Roth IRA for 5 years.
Yeah, you see, the Roth 401k...
The rules are a little different, and they have different distribution taxabilities.
As we talked about it, I think we talked about the Roth 401k.
But understanding how to deal with this just makes life a little bit more simple. I mean, maybe not simple, but it makes you maybe save some money in taxes. You have to understand how the taxes work to be able to manage. If you don't understand how taxes work, how do you manage them?
Exactly.
And you got to manage them.
Okay, so it's taxed at if you own it personally, and in our
own it personally, selling a stock is a capital asset. I get a capital gain on the difference between what I paid for it and what I sell it for.
On the gain, yeah.
Distribution from an IRA, regardless of what happened inside the IRA, whether it came from interest building up, capital gains, short-term, long-term, or it's a return of my own money, the distribution from a traditional IRA, assuming you don't have any pre-tax or post-tax money in, is all taxed as ordinary income. Distribution from a Roth prior to 59.5, complicated as all get out, basis first, conversion second, After 59.5, 5 years, qualified distribution, tax-free, wonderful thing.
As long as we've been in the club for 5 years.
Right.
At least.
Now, does that mean that I should never buy stocks in my IRA?
Well, okay, yeah, that was going to be my question.
Should I never buy it in my personal account? Should I only buy them in my Roth IRA?
Wouldn't it seem that way? Because tax-free, I would think, is always better than taxable. But let's talk about that real quick.
Well, the idea is most of the time, especially if you're younger, 20, 30, 40, even 50 for sometimes, where is the money? Almost all of your retirement money should be invested for growth. So regardless of whether it's in an IRA, a Roth IRA, or a personal account, it's going to be invested for growth if it's retirement money.
You would hope.
Now, if it's emergency money, that should not be in an IRA.
That should be...
Because that's penalized if you get to it.
Somewhat liquid, actually.
It should be in your personal account. A Roth IRA can work for somebody who's just starting their investing habits as an emergency fund, because if I'm contributing, $4,000 or $5,000 a year and I'm trying to build up my emergency fund, Well, I can also start building up my Roth in the hopes that I don't have an emergency. And then if I do have an emergency, I can always take out my contributions back without penalty in a Roth.
Well, and let's instead, we talked about traditional IRA or Roth IRA. We could also say 401k.
401k.
Because a 401k, as I understand it, acts very similarly, in fact, if not identically, to the traditional IRA in many respects as far as taxability goes. When I take money out of my 401k,
it's going to be taxable
at ordinary income rates.
Right. And so how you treat your 401k, should you not? I was talking to a gentleman today. He's 60 years old. He has assets. He has them allocated fairly well. He's starting a brand new 401k, and he doesn't have any money in it yet. He's just now, and he's asking questions about, well, how do I allocate my contribution? It's a 401k. All this contribution should go to stock. 100% of this contribution.
He's retiring when?
No, he's retiring not for another 7 or 8 years.
Okay, all right. So
but he got a new job, and he's got a new 401k. So he has other monies that are allocated.
Got it.
But this account, everything in it is going to come from future contributions. And so even though it's a tax-deferred account and it's not going to have the best tax treatment on the capital gains, it should still be invested for growth.
Well, sure, and that's part of the asset allocation inside the 401k.
Right, and the asset allocation in the 401k should be for growth because it's new money going in, dollar cost averaging. He has other former 401ks that are invested for some safety. Basically, his bucket's 2 and a little bit of bucket number 1 because he might retire in 5 years. So he's got the money allocated, but new money going in, that's bucket 3. I don't care which account you're putting it into.
But this is not to say, of course, that because it's ordinary income tax coming out of a 401k, let's say, or a traditional IRA, that's not to say that it's the wrong move, because you asked that question a little bit ago. Why shouldn't I just do all Roth? Well, for one thing, I think, Professor Plum, especially if you get a late start, you can save potentially a whole lot more in, say, a 401k because the contribution limits are so much higher, right?
Well, yeah, you can put in 19.5 or 26,000 if you're 50 or older, versus 6,000 or 7,000 if you're 50 or older.
That's in 2021
numbers.
Depending on when you're listening, but yes.
But in his case, in this particular gentleman's case, doing a Roth 401k, he has the option. Doesn't make any sense. He doesn't have that much money. He doesn't have millions. He's got a little bit here and there. But when he retires in 5 or 6 years, he'll probably have about $250,000 saved up in all of his different accounts. So that's going to give him about $10,000, $12,000 a year of distribution on top of his, $20,000, $30,000 of $30,000 plus of Social Security. He's not going to owe any taxes because of the standard deduction. He's getting a deduction today where he's making like $50,000 a year as a single guy, and he's in the 12% federal income tax bracket, plus the state he lives in has a little bit of a tax. So he's getting a tax deduction today, and then when he turns around and takes it out 6, 10, 15, 20 years from now, he's not going to owe any taxes on it.
Because of the standard deduction.
Because of the standard deduction, because of the way the tax brackets work. So these ideas that always do your Roth 401k or something of that nature don't always work. It depends on where you're at. On the other side, I was talking to somebody the other day who they're still making $100,000+ a year. They're in a pretty high tax bracket comparatively. They're going to start doing their Roth 401k because they've already got a ton of money socked away in traditional. And by the way they're looking at it with their pension and their Social Security, their tax bracket could be even higher in retirement than what they are today, even though they're in a reasonable bracket today. Everybody is different. And the advice of always do this or never do that doesn't fit. I was talking to somebody about doing a Roth IRA the other day, and they were in their 60s. They said, well, I thought Roth IRAs were only good for young people. Well, true. There's a lot of things that being young has an advantage for.
Yes, time is a great mitigator.
But it doesn't mean that it's not good for you. In what you're trying to accomplish, the Roth IRA is a better, in that particular instance, was a better deal than doing a traditional IRA.
Well, so many people, some people, I don't know how many, but some people have a mixture by the time they hit age 65 retire. They got a 401k.
Flexibility is a good thing.
A couple of 401ks. Maybe they have a traditional. Maybe they have a personal brokerage account, and maybe they have a Roth or two. I mean,
and if they don't have a Roth or two when they first retire and they don't have any income from other sources, maybe they do some conversions.
Maybe, but the important thing that we're talking about here, Professor, I believe, is to know that if I take money out of this account, how's it going to be taxed? If I take money out of that account, how's it going to be taxed? And what, based on where I am today, how can I take my current situation and use it to my tax advantage, right?
Right, and it depends on where you're at today and what the future holds, especially when the required minimum distributions from traditional IRAs, 401ks, other qualified retirement plans accounts kick in. Because you may be able to keep yourself in a very low bracket today. Well, you may be able to keep yourself in an almost 0% bracket today, or pay no taxes because maybe you took your Social Security and you're just living off the bank account for the next several years because I don't have to pay any taxes for a little while.
But guess what?
But I had this, $500,000 million IRA that I'm not taking any money out of, and I'm 65, and so for the next 7 years, I got no taxes. I'm living on my personal account, and then, darn it, age 72 came up.
There's a bear in the woods.
Yeah.
If you remember that old reference. Yes.
Age 72, the required minimum distribution, and my IRA has been growing. It's been just sitting there for the last 7, 8, who knows what it's worth. But the required minimum distribution now comes in, and maybe it is what I need to live on. Maybe it's, maybe I was taking $40,000 a year out of my, bank account to live off of, plus my Social Security.
But now you hit 72.
And my IRA is $1 million, and I got to take $40,000 out of that. Okay, I'm getting $40,000 there. I just stopped taking out my personal account, right? It's not going to be the same. Because now I'm going to owe taxes on the majority of that $40,000. The standard deduction isn't going to wipe it all out. And oh darn, a big chunk of my Social Security, which before was not being taxed, is now being taxed. So I'm losing some portion of that $40,000 to taxes.
See, and that's the problem. I mean, you thought everything was fine starting at age 65 when you retired. You're in a
zero
lower
income
zero.
tax.
You're skipping through the hillside, picking strawberries, whistling, zipping.
I'm getting $65,000-$70,000 a year of cash flow, and I'm not paying any taxes.
Right.
I'm brilliant.
You're brilliant
for 7 years
until the required. So what you're saying is maybe you look at
got to look at the bigger picture.
Some of that money out of the, and everybody's different.
Everybody's different.
But you should maybe look at, hey, if you got room in the tax bracket, maybe take some of that money out to lower that required minimum distribution.
Right. And use the 72 tax brackets to your advantage. We talked about the standard deduction earlier, being $25,000 and change for a married couple.
Yeah.
Don't let it go to waste. I mean, if God got the ability to use up some, to take distributions from my IRA and not pay any taxes on it because of the standard deduction, don't waste good.
No, I mean, maybe you've got, a bunch of money sitting in your personal account. You're just your checking account or whatever, and you're going to live off that for a few years. Well, you're not paying taxes on that because
you're taking principal out.
You're taking principal out of that. Well,
and how much is a bank account earning right now?
Well, you're not going to be up in any tax bracket. So in that instance, you may have, if you're married, $25,000, $26,000 plus $1,000 of room to take money out of your IRA or whatever, convert it to a Roth and still pay no tax.
Right. So you can still live on the personal money, but don't let the tax bracket go to waste. Use the conversions. Convert traditional IRA to Roth. Or live off the traditional IRA and invest your personal money for growth.
Sure.
Or defer taking Social Security and have even more room to play with.
And you can convert really any amount you want out of that, right?
Conversions, the only limits on converting from traditional IRA, 401k type money to a Roth is the required minimum distribution. You are not allowed to convert an amount equal to the required minimum distribution.
Which is only going to affect you if you're 72 or older.
But even if at 72 or older, this is a misconception too. I've had people who are in their 74, 75, 78 say, well, I can't do conversions anymore because I'm not working, and B, I have required minimum distributions. I said, well, you cannot contribute because you're not working. But as long as you take your required minimum distribution out, if you still have room in the tax bracket and you want to do conversions, you can convert at any age, as long as you're not converting an amount equal to the RMD.
Take the RMD first.
Yeah.
Get that out of the way. And then you're free for the rest of the year to do what you want.
Yeah, you can do whatever required, leave the required minimum distribution in your bank account or whatever you want to do, but you can convert any amount you want up to 100% of the remaining IRA.
This is this is an RMD discussion, which is fine.
Well, when you're talking about taxes, especially for retirement, you have to look at required minimum distributions to figure out where am I going to be today, where am I going to be in the future, and what do I have to worry about? You don't want to wait until age 72 to be surprised by the RMD. You want to build it into your plan.
You don't want the bear in the woods to jump out at you from behind a tree. You want to see it coming way down the road so you can maybe reduce it in size.
This is one reference I don't know that you're talking about. Usually,
you don't remember that?
Usually, you and I are on the same page for references.
Do you remember the presidential campaign of 1980? It was
Sort
the
of.
communist reference.
Yeah,
it was
the Soviet bear.
Those Reagan ads, yes, and it was.
I don't remember
they come
the
on
ads.
and say, "There's a bear in the woods," and you see the bear. I mean, they didn't say what it was, but we know what you mean, the Russian bear. And it was coming to attack America and all that stuff.
I don't remember those ads.
Wow. Okay. Gee whiz. Well, anyway. There's a bear in the woods, and that's what that is. This is stuff you got to really pay attention to. It depends on where you take money out. We've talked about asset location. If you got money located in several different types of accounts that create several different types of taxes, Professor, again, the point is know what's going to happen when you take money out of one or the other.
And know where the pitfalls are.
Yeah.
Is it affecting the taxation on your Social Security? Is it affecting, the bracket? Are you jumping a bracket by taking more money, or should you take it from another area?
Yeah.
Are you affecting IRMA, income-related monthly adjustment amount for Medicare?
We didn't even get to that.
Are you affecting the net investment income tax? Are you? There's all along the spectrum, depending upon whether you're making $30,000-$40,000 a year in retirement or $300,000-$400,000 a year or more in retirement.
How is somebody supposed to figure this out? There's a way they can maybe do that, and I would suggest that you talk to a financial advisor to help you out.
Yeah, because this is what we do every day.
Every day. Lucia Capital Group, Professor Plum, you and the team of financial advisors. There really is a big team back there working with you.
We've got a lot. Well, not, we all have people we're working with. We all collaborate. We all talk about these different issues. We talk about different strategies, how they affect, when they affect, what's going on. So yeah, we all work as a team, but
Yeah, any one of the advisors, and what they'll do is they'll work with Professor Plum or work it out on their own, and then Professor Plum, you take a look at each plan. Right. And others too, and they say, "Well, how about this? Okay, this might work good. Oh yeah,
let's brainstorm this and see what we can make it work."
And it's a puzzle that you guys really enjoy doing.
I do.
Yeah, well, everybody else does too. It's just a game, and you have to have that certain kind of personality, but that's why they became financial advisors. You may want to talk to any of them at Lucia Capital Group. Maybe Professor Plum, if you're lucky, 800-644-1150, 800-644-1150. They've been sponsoring this podcast and our TV and radio shows for decades now, and there's a reason for that. We believe in them. 800-644-1150. You can also talk online or go online, check out all this content, including some of our Lucia Capital Group weekly features, where we talk in smaller sound bites about a lot of these topics. LuciaCap.com, LuciaCap.com, and get all the information that you need right there. Well, I hope it's all the information. If you don't get all the information, check with us.
Well, send us a letter and what you're interested in. We'll make a podcast about it.
I would love to do that. Again, we try to take these situations and that clients and
Did I say send a letter?
You just told me you're over age 59 and a half, Professor Plum. We forgive that automatically, okay? Send a self-addressed stamped envelope to Lucia Capital Group. Self-addressed stamped envelope.
An email will work fine.
It will work fine. You can do that, self-addressed stamped email. No, LuciaCap.com. And by the way, as I said earlier, if you want to subscribe to this podcast, we would love to have you download these episodes or get them downloaded to your device every single week. Go to Spotify. Spotify, that's where we are, and become a subscriber. We have a lot of subscribers. We would love more. Go there, and we'd love to talk to you more about that, too. And as Professor Plum says, you have a topic you want, just let us know. Out of time. We went a little over time, but that's fine. This is a very important topic. We'll get to more. Two more episodes left in this season. Got to find out what we're going to be talking about next week. Tune in for Professor Rick Plum, Certified Financial Planner, Professional. I'm Johnny Dean, your podcast host. Thanks so much for listening. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.